Welcome back to the Supply and Demand Pro Trader series. In this series, I teach you how to draw a complete picture around supply and demand. This is lesson 4. Today, we are diving into the exciting world of supply and demand dynamics. First, let's review the market concept. Then, we'll emphasize the importance of trading objectively, focusing on what's real, not what you feel. Get ready for an engaging session packed with valuable insights.
All right, let's say you've never read a trading book before, and let's say you've never heard of conventional technical analysis, fundamentals, news, or anything. You've never heard of any of that stuff. And then you came across this thing called trading and investing, and you say, you know what? I want to learn how to do this. And to top this off, you're on an island. You have no access to anybody or anything. You've just got a laptop, internet, charts, and trading capabilities. What are you going to do? Think about it. Your first conclusion is going to be that the only way to make money doing this is to buy low and sell high, or sell high and buy low. I think we all come to that conclusion pretty easily. If you came to that conclusion, which is how you make money buying and selling anything, the second conclusion you would come to is, well, where do you buy and sell in the market? Well, you want to buy low and sell high. So obviously, to keep the risk low and the reward high, you're going to identify turning points. You're going to have to figure out where the market's going to stop falling and turn higher, where the market is going to stop rising and turn lower. Or in other words, where will market price move to? Do you agree with me so far? If we can agree to that, then the final conclusion we would come to is to figure out where every market on the planet is going to turn. Well, where and why do prices turn in any market in any time frame? The answer is prices always turn at price levels where supply and demand are most out of balance. Would you agree with that? If we would agree that prices turn in markets and every move in markets starts and ends at price levels where willing supply and willing demand are most out of balance, then the only question left is, how does that picture look like on a price chart? If you really think of it that simple, you can now completely skip the whole world of conventional technical analysis and news. That's step number 1. Number 2, we're going to focus on who is on the other side of your trade. A lot of people don't consider this, but it's one of the most important things you need to focus on. How do you know whether the person on the other side of your trade is a consistently profitable trader or a losing trader? You need to know the difference. What if every time you push the button to get in or out of the market, there's a consistently profitable trader on the other side of your trade? You're in trouble. Make sense? How do you know the difference? More importantly, if you cannot tell the difference between a novice trader and a professional trader on a chart, if you cannot spot the difference, guess who that novice trader might be? I say that with all the care in the world. We are going to deal with this right now. You need to make sure that you are trading against people that have no idea what they are doing. We'll get into that more in a minute. All right, let's start to deal with step number 1 first. Let's focus on this area right here. Prices are trading sideways. Supply and demand appears to be in balance. Whatever market this is, whatever time frame this is, does not matter. All of a sudden, there's a drop in price. Now, a lot of you will look at this and say, I can't wait to learn how to predict that. This is going to happen before it happens. Or I can't wait to learn how to make money when prices fall when they do here. Make sure you understand that we are not going to do either of those two things. Instead, we let price move away as they do here, because when they do, that's when we conclude that supply exceeds demand at the origin of that drop. In other words, the only way that we know that supply exceeds demand here is the way price is moving away from this level. It drops away because of supply and demand imbalance right here. Now, to me, I see this chart like everyone else does, but I see it maybe a little bit different because I did not start out reading a trading book or anything like that. I started my trading career learning from former floor traders, and they would have big stacks of buy and sell orders in front of them from banks, institutions, hedge funds, money managers, you name it. They could see what a big stack of sellers, what supply really looked like when they had the orders in front of them. And I'm now showing you exactly what that picture looks like on a price chart. The fact that price drops as it does here tells us that supply exceeds demand at the origin of that drop. So what we are going to learn to do is to wrap two lines around that level, proximal and distal line, highlight the area with a yellow box, and carry that level forward. Bottom line, we are creating a supply zone. Down at the bottom, just the opposite is true. Prices are trading sideways, and all of a sudden, there's a strong rally in price. Once this rally happens, again, that's when we could say, we know now where the real willing buyers are in this market, where objectively demand exceeded supply. Again, once that rally happens and this becomes a demand zone, that's when we draw our proximal and distal lines in. We wrap two lines around this level and carry this level forward, creating a demand zone or buy zone. We want to know where the real buyers are in this market. Remember the question and premise that we started with in the beginning. Just that basic sequence of questions. We are answering it now. What we have started to do is identify supply and demand in this market. Now, how can I be so confident when I say demand exceeds supply there? How can we be so confident? Well, because if that statement was not true and there was equilibrium here, wouldn't prices just keep trading sideways? See what I'm saying? They would. But the fact is, they couldn't, and price had to rally away. Let's deal with step number 2 now. Understanding who is on the other side of your trades, very, very important. We started to quantify what supply and demand looks like on a chart in the market. Now let's start to figure out who is on the other side of our trade. We need to be able to identify the novice trader in the market. Think of it this way. Walmart, one of the biggest retailers in the world. What are the two things Walmart needs? How do they make so much money? They don't really produce anything. They are just the middleman between us and the product. So what are the two things they need to be able to master? Number 1, they need to be able to master the science of buying at wholesale prices and selling at retail prices. The second thing they need to be good at is getting people to come into their stores. Those things go hand in hand. So let's deal with step number 2 here. When people come into the market, we want to know exactly who we want to sell to and buy from. It needs to be the same group of people every single time. So take a look right here. If we focus on this area, upper base novices, we are going to specifically focus on the buyers. And there are only two groups of traders. There are traders who make money and traders who lose. There's hardly anybody in between. The people who lose, the novice retail crowd that loses, always makes two clear mistakes. Let's look at and show you what that looks like on a chart. The buyers here are making those two mistakes. They're buying after rallying price. Mistake number 1. Buying after rallying price, not a smart thing to do. You would never do that in any other part of your life and be successful. Mistake number 2 that these buyers are making is even worse. They're buying right into a price level where supply exceeds demand. The laws of supply and demand guarantee that if you buy after rallying price into a price level where willing supply exceeds willing demand, you're going to lose consistently. Maybe not every time, but most of the time you're going to lose. Instead of being that buyer, we want to be the seller. Prices drop as we would expect. So down at the bottom, just the opposite is true. But it's the same group of traders. If we focus on the sellers, it's the same group of traders that are selling after a drop in price. Mistake number 1. And selling into a price level where we already determined demand exceeds supply. Mistake number 2. Now we want to be buyers right here at the proximal line and put the protective stop just below the area. Buying right here at the proximal line, according to our rules, is the lowest risk, highest reward, and highest probability time to buy into this market. But here's the catch. The trading books, all the trading books, and everything in the world of conventional technical analysis says, don't buy here. Let me explain. The books say, don't buy here. You don't know if there's any buyers yet. Wait for a green candle. The keyword? Confirmation. It's in every trading book ever written. The book says, wait for confirmation of a green candle, then buy. But if we wait for confirmation here and then buy, what's now happened to our risk? Is it gone up or has it gone down? It's gone up. What about reward? Has it gone up or down? It's gone down. That's the last thing we want to do. You can let everybody that reads the books buy here, but you don't want to buy here. You want to buy down here at the turn. Now, what if I were to put any indicator or oscillator on this chart? Would they have me buying down here? What if I put a moving average on here and any of those things, are they going to have the buying right here at our proximal line? No, the moving averages aren't even going to start turning higher until, well, after this green candle starts forming. What that lagging school of thought does, which is called conventional technical analysis, what it does is guarantee that you will not take the low risk, high reward entry. All those things, whether it is chart pattern entry, which are all breakouts, or any indicator or oscillator based entry, they all lag price. They're all just derivatives of price. They're going to do what price has already done. Here's the big thing you need to remember. Adding anything to your analysis that lags price, or adding anything to your decision-making process that lags price, adds risk and decreases profit margin. No thanks. You can do it if you want to, but I'm warning you not to. So we started to learn how to quantify supply and demand in the market, and we start to learn who we want to sell to and buy from. If we were in Walmart training right now, would we be talking any different? Here are retail prices, here are wholesale prices, here's the people we want to sell to, our retail customers, and here's the people we want to buy from. Makes sense? If this was like Walmart training, we would be having the same conversation. The big misconception that people have, especially new traders and people new to the market, is they think how you make money buying and selling anything is somehow different from what you should be doing here. The reality is that it is no different at all. Take a look here. Make sure you are able to clearly spot that novice trader around that chart. Someone who is buying after rallying price into price level where supply exceeds demand. That's a novice buyer. Only a novice buyer would do that. Of course, on the downside, anybody who is selling after a drop in price and into a price level where demand exceeds supply, we want to be buyers from that seller. Now, there's a little bit more to it than this when we get into the institutional footprints, what we call zone qualifiers. But I don't want you to go out and buy and sell on every 5-minute demand and supply level you find. You have to know where those are in relation to larger time frame supply and demand. Not complicated, but I just want to make sure you understand that. So it really comes down to having this razor sharp focus on answering the questions that we just discussed and looking at the price chart to do it. Where will price turn? Where will it move to and go? And who is on the other side of our trade? Unfilled orders cause prices to turn. Another word for unfilled orders, supply and demand. Filled orders or a lack of supply and demand facilitates price movement. That's the whole goal of this, is when you look at any price chart of any market for any financial purpose, what you're seeing on the chart are those two things and those two things only. Filled orders, unfilled orders, because everything on the chart represents those two things. The problem is most people don't even know to look for that, number one. Number two, when the logic makes sense, they don't know how to identify it. Is there a third thing that is reflected on a chart? Is there anything else reflected on that chart besides filled orders or unfilled orders? No, there's not. The chart itself is actually only made up of one thing. It shows you where the filled orders are. That's a print on the screen, a candlestick. Now, by applying our supply and demand strategy, we can spot the institutional footprints and we can identify the hidden unfilled orders.
Now, let's dive into all these fascinating things right here. The amount of information out there is mind-boggling. And guess what? It all affects the way we buy and sell. We've got earning reports, income statements, central bank announcements, technical indicators, investment tips, broker recommendation, analyst opinions, and news. The question is, will we interpret it in the same way? No guarantees, right? With so much information, it's bound to create different thoughts and perceptions, which ultimately drive buying and selling decisions. But here's the kicker. You never truly know if the info is legit. And you know what else? We don't know why people make those decisions either. But hang on, because here's what we do know. The big banks and institutions, they're way ahead of the game. They've got the news before we even think about it. In fact, they might even control the distribution of certain information. Crazy, huh? But here's the exciting part. The market itself has nothing to do with the actual market. It's all about people looking to buy low and sell high. And it's all about understanding the rules of the game. So don't stress about being right all the time. Focus on consistency and risk management. Because let's face it, we'll never quite grasp why everyone jumps on the bandwagon at the same time. Instead, let's focus on learning the where. Let's spot those institutional footprints, detect supply and demand levels. People may not tell us why they are making moves, but hey, as professional traders, we can read the price chart like no other. And here's something to ponder. What does the market actually consist of? That's right, orders, unfilled and filled orders. So even if the wildest news hits the scene without anyone placing orders, the market remains stagnant. It's those orders that make price soar and plummet. Exciting, isn't it? So remember, in this crazy world of trading, it's all about orders. I hope you found this lesson enjoyable and informative. I know the general consensus on YouTube that educational content is boring, but I'm doing the best I can here to make some of my OTC content available on YouTube. So having your likes, your comments, the discussions that we always have, the occasional scalpers showing up from time to hate, I really can't have enough of all of this and enjoy being part of this community. So thank you. Stay tuned for more exciting content. Happy and safe, set and forget trading, folks.